This is Satya Pradyuman of Cirrus Research. I want to call your attention to the latest issue of the Earnings Playbook. This examines the outlook on earnings for the market across sectors, industries, and even stocks. The title of this issue is Lower Hurdle to Temper Earnings Slowdown. And the bottom line here is what we're finally seeing is the consensus estimates are starting to come down nicely. And as a result, as much as this earnings season will likely continue to have negative earnings or slowing earnings growth, the reality is that given that the estimates are coming down nicely, we're less likely to see as dramatic a whipsaw in market price action. Let's get into the details. A few key points here. Healthcare. It's really the only sector where we saw earnings expectations remain stable or even slightly go up. All the other 13 sectors were markedly down. Labor markets reflect an especially soft patch as IT consulting and HR groups, their estimates are sharply pared back. In addition to that, the home builders data that we're looking at, because everybody's thinking about housing, the reality is that those estimates have come down. On the other hand, though, the revenue numbers, I think, are just starting to roll over. So let's go through a few of the details. Number one, we talk about earnings torpedoes and fallen angels as a way to play offense and defense. The idea here is that if the earnings will continue to slow for many firms, then what we want to do is look at earnings torpedoes as a defensive measure. In other words, what are those firms where the estimates are really aggressive? I guess the idea here is that you can only fight gravity so much. So if the old system is slowing and you've got a few firms where the forecasts are way out of whack or out of line, those are potentially most likely to be a torpedo candidate. So we think the work in the report walks through a few sample ideas as well, and vice versa. We've seen a lot of damage, especially in the smaller cap market. Are some of those firms now real value? So the idea here is let's look to see if the estimates have truly broken and the sell side forecasts are very tightly compressed. So I think this torpedo fallen angels work is something to focus on. And then in terms of the specific comparisons, this is an example of the healthcare curves that I flagged earlier. What you're looking at here in blue are the earnings estimates. And so what you would see for most of the equity market is the forecasts are starting to come down in a sharp way. The reality is that the hurdles are already fairly benign for healthcare. However, they remain stable, which sort of makes sense. Healthcare more broadly tends to be more defensive. If you look at the top line growth, we've certainly seen the pandemic and the post-pandemic move. So we are seeing that slowdown in top line growth as we are seeing in every sector. And then finally, this is a curve, similar comparison looking at HR, where we've seen a sharp breakdown in the forecast for HR services in their earnings estimates, and top line growth is starting to slow, but we suspect this will continue to come down. So yeah, take a look at the playbook. We think there's a lot of neat stuff in there that tackles this earnings season more strategically. And thank you.